Alright guys, let's revise quickly cost of capital better. So I told you what is the significance of cost of capital guys. Whenever a company takes any investment decision, the cash flows will arise at different points of time, and that is why the cash flows will not be comparable. You will have to bring it to a common time base. To bring those cash flows to a common time base as such guys, you will be needing a required rate of return. So the discounting rate at which you're going to evaluate all the investment decisions guys is nothing but your cost of capital. Okay. So, and also guys, in case of credit policies to be offered, also I told you better how much credit is to be given to the customers. That will in turn will depend on your cost of capital. We're going to learn about cost of equity, cost of debt, cost of preference share capital guys under cost of capital, and cost of retained earnings. For any source of capital as such guys, there can be expenditure that you are incurring at the time of issue of security. There can be expenditure guys at the time of redemption of security, and then there will be regular payments in the form of interest or dividend. Practically as such guys, when you talk about cost of debt, I said that cost of debt as such better will depend on the risk-free rate that is prevailing in the country, and plus the risk premium that the investors would want as such guys, depending on the risk involved in the security. That is basically better computed by way of credit rating. Higher the credit rating of a company, lesser will be the risk involved in the security, lesser will be the expected return. Lesser the credit rating, higher will be the risk involved, higher will be the expected return. Are we clear about this? Now, what we learn guys here in our syllabus is a post-mortem analysis, meaning we already know the price of the security, we know what is the coupon rate, we know what is the redemption value. Based on that, we're trying to compute what is the cost of debt for the company. I already told you, reality mein aisa nahi hota hai. We will only have to determine what is the coupon rate that is to be offered. So for cost of debt guys, normally we assume that interest rate itself is the cost of debt. But I just told you better, apart from the regular interest expenditure, there will also be expenditure at the time of issue of security and expenditure at the time of redemption of security. That is going to impact your overall cost of capital. Yes, that is going to impact your cost of capital. I am issuing a security at 95 rupees, but I am paying interest on 100 rupees. That interest percentage is not my cost of debt because I have received only 95 rupees. This is where as such beta we will have to learn about different cases. Now, in case there is no issue expenditure, there is no redemption expenditure, I am issuing a security at face value, I will be repaying face value, then the amount that I have received is also the amount on which I am paying interest. That is why I can directly write cost of debt as interest rate into 1 minus tax rate. For term loan, because normally there is no issue expenditure, there is no redemption expenditure, you will always write cost of debt is equal to interest rate into 1 minus tax rate. So check whether it is a security that does not involve any expenditure. If yes, we do not care what is the redemption period, whether it is irredeemable, redeemable, 3 years, 5 years, 10 years. You will directly write cost of debt as interest rate into 1 minus tax rate. There was a question in which they mentioned that the bank loan has a period of 5 years. We do not care about that 5 years. Obviously, bank loan है बेटा कभी ना कभी तो repay करना पड़ेगा. Whether it is 5 years, 10 years, 20 years, you will still write cost of debt as interest rate into 1 minus tax rate. That's the first case. If the amount that you are collecting is not equal to face value, or the amount that you will be repaying back as such beta is not equal to face value, then you talk about the subsequent cases. This is where you will have to check whether the security is irredeemable or redeemable. In case the security is irredeemable, it will be considered to be a constant perpetuity. This is where beta cost of debt guys will be computed as interest amount into 1 minus tax rate divided by net proceeds. We are using the formula of present value of constant perpetuity. You just have to worry about what is the expenditure that you are incurring at the time of issue of security. So it is interest amount into 1 minus tax rate divided by net proceeds. When do we use this? If there is irredeemable security and there is some amount of expenditure incurred. If they do not talk about maturity period, we always assume that the security is irredeemable. If they simply mention a 12% debenture of a face value 100 has been issued at 95. They do not specify anything else. You assume that the security will be perpetual, irredeemable. If they mention 12% debenture of 100 rupees issued at par, then I do not have to worry about redeemable or irredeemable because there is no issue expenditure. I can directly write cost of debt as interest rate into 1 minus tax rate. Are we all clear about this? In case it is a redeemable security, that is the next case, case 3. I said there are two ways of arriving at the answer. One is the approximation method, the other one is the YTM method. Accurate answer obviously is given by YTM method. Under YTM method, we are in search of a discounting rate where the present value of all the future outflows will be equal to the amount of net proceeds. Do not forget, when you take future outflows, you should take interest amount net of taxes. Do not directly take interest amount. So you will write net proceeds is equal to interest amount into 1 minus tax rate into PBAF plus redemption value into present value factor. You can use the shortcut method. So first, approximation method, my guys. It is average annual expenditure divided by average amount outstanding. That is written as interest amount into 1 minus tax rate plus redemption value minus net proceeds by n, whole divided by redemption value plus net proceeds by 2. Interest amount into 1 minus tax rate, beta, is your regular interest expenditure. Redemption value minus net proceeds by n is the capital loss or gain, divided by redemption value plus net proceeds by 2 is the average amount outstanding. This is how you will be computing cost of debt using the approximation method. So even if there's a question on YTM method, you can always use approximation method, arrive at the approximate cost of debt. Then you will know, guys, under YTM method which discounting rate are you supposed to start with. After this, beta, we moved on to zero coupon bond or deep discount bond. A zero coupon bond or a deep discount bond does not result in any payment of coupon. There's only redemption value directly payable on maturity. These bonds are issued at discount to par value and are redeemed at par value. So you just have to use the formula of compound interest. There is no approximation formula here because actual YTM method itself is so simple that you will not need any approximation formula. You will write accumulated balance is equal to P into 1 plus R whole power n, where accumulated balance is redemption value, P is the amount of net proceeds. Hope everyone is listening. So write accumulated balance, beta, that is redemption value is equal to net proceeds into 1 plus R whole power n, where R becomes your cost of debt. Is that clear, guys? Next, beta, we spoke about a convertible security. A convertible security is similar to redeemable security, just that upon maturity, the holder of the instrument will be given an option either to opt for cash payment or opt for equity shares. The holder will obviously exercise the option that is going to result in a higher amount. If cash component is higher, they will select cash component. If the value of equity shares is higher, they will select equity shares. So everything else same, beta, that is you will still write interest amount into 1 minus tax rate plus redemption value minus net proceeds by n, whole divided by redemption value plus net proceeds by 2. Just that redemption value should be higher of cash component and expected value of equity shares, not today as in the end. For this, if they are giving us price of equity share today, they will give us growth rate in price. So you simply have to keep increasing price by that growth rate. You will directly get P5, P6, whatever is required. If price is not given, they might give dividend. Then you will have to use that relation. P5 is equal to D6 by KE minus G or P6 is equal to D7 by KE minus G. अगर वो already price दे रहा है बेटा, he will also mention growth rate and price. If that is given, very simple. Usually that only comes in the examination. They will not expect you to write P6 is equal to D7 by KE minus G. They will give you price, today's price, and they will give you the rate at which the price is going to increase year after year. If they give growth rate in dividend and not growth rate in price, then you will have to use dividend discount model. D7 by KE minus G will become P6 or D6 by KE minus G will become P5. Are you getting the point, guys? This is for what? Convertible security. And then if they use the word current cost of capital, everything same as such, guys. Net proceeds should mandatorily be based on the current market price. But now that we are done with all the questions, guys, you know, in case they give market price of the security in the question, it is mandatory for us to compute net proceeds based on market price. We do not do it on the basis of face value. So if they tell us that the current market price of a debenture is 110, you will write net proceeds is equal to 110. Of course, if there is any flotation cost, you're supposed to deduct that flotation cost. Flotation cost will always be as a percentage of issue price or market price. It is never as a percentage of face value unless otherwise given in the question. If they mention that flotation cost is as a percentage of face value, only then you will take flotation cost on face value. Otherwise, flotation cost should always be considered on issue price or the current market price, whatever is given. If they give current market price is 110 and flotation cost is 2%, it will be 2% of 110 rupees. Are we clear, guys? This is all that you should know in relation to cost of debt. Kuch zarat nahi aur. Every question will revolve around these points only. Majority of the questions, they might not give redemption period, they might not give issue price, nothing. There it is very simple. You'll simply write cost of debt as interest rate into 1 minus tax rate. If they give issue price, do not mention maturity period. Assume it is perpetual, irredeemable security. Any doubt in this part, guys? Understood everything related to convertible? Convertible security के लिए the only place that it can complicate is price of the equity share. You do not need current price, you need price as on a later date. Only two things that they can do there also. Either give you current market price and give you growth rate in share price, or give you dividend ka growth rate, give you cost of equity and everything as such beta, and using, sorry, give you cost of equity and using that as such beta, you will arrive at price at the end of the maturity period. Are we clear? The next one beta is cost of preference share capital. Cost of preference share capital beta, I told you, is exactly similar to cost of debt, except debt is considered as an obligation. That is why interest on debt beta is a charge against profit and it results in tax savings. Dividend is considered to be an appropriation of profit. Because it is an appropriation of profit, guys, there will not be any tax savings on payment of dividends. So you will not write into 1 minus tax rate anywhere. Again here beta, if there is no issue expenditure, no redemption expenditure, if they simply mention we have 12% preference shares, your cost of preference share capital will be equal to 12%. In case they give us issue price or the current market price as such, guys, you will have to compute based on the redemption period. If nothing is given, even here we assume them to be irredeemable or perpetual. For irredeemable preference shares, guys, cost of preference share capital will be preference dividend amount divided by net proceeds. For redeemable, again you will have approximation method or YTM method. Under approximation method, you will write preference dividend plus redemption value minus net proceeds by n, whole divided by redemption value plus net proceeds by 2. Under YTM method, guys, you again have to arrive at the discounting rate at which the present value of all the outflows, that is preference dividend into PVAF plus redemption value into present value factor, should be equal to your net proceeds. Are we clear, guys? After that, as such beta, we moved on to cost of equity. The difference between cost of equity and cost of preference share capital and cost of debt beta is that equity is an instrument under which the holders are entitled to a variable return. There is no fixed obligation on the part of the company as such, guys. In spite of that, that is a source of capital. The people who are putting in money will have expectation. That expected return of the investors itself will become cost of capital for the company. So to compute this cost of capital, the first method that we use, which is universally accepted, guys, is capital asset pricing model, CAPM. As per CAPM, the required rate of return, this CAPM, guys, practically is not used just for equity, can be used for any instrument. Everywhere required rate of return will always be risk-free rate plus risk premium. So anyways, as per CAPM, the required return from equity, guys, should be risk-free rate that is prevailing in the economy plus the risk premium that you should get for investing in a specific security. So to compute this risk premium as such, guys, we need beta factor. Beta is a measure of risk which compares the risk of a security with the risk of the market. If beta is 3, it means the security is 3 times riskier in comparison to the overall market. So the terms that we use here is RF, RM, RF, beta factor. RM is market return, RF is risk-free return, RM minus RF is equity risk premium or market risk premium. RM minus RF is the risk premium that the overall market is getting. It can be termed as ERP, equity risk premium, or MRP, market risk premium. Beta times of RM minus RF will become our risk premium, the risk premium that you should be expecting. So if market return is 12%, risk-free rate is 7%, the market risk premium is 5%. If the beta of your security is 3 times, you should not get a risk premium of 5%, you should get 3 times of 5%, 15%. That is why the formula here beta is RF plus beta into RM minus RF. I also said beta that as per CAPM, or risk is overall segregated into 2 categories. There is systematic risk and unsystematic risk. Systematic risk is on account of macroeconomic factors, the factors that are going to affect all the companies. To what extent it may differ as such beta, but it is going to affect all the companies. Just say, though in the last 2 months as such guys, a lot of companies stock prices reduced, steel sector did well. Why? Because there was an anticipation that the government was going to levy anti-dumping duty on Chinese steel. So if that is levied as such guys, automatically the demand for Indian steel companies will increase. So that is why if you look at any steel company as such guys, last 2 years the return has been good, favorably high, plus 20%. Though all the other companies that are minus 15%, minus 20%. Though the overall markets were crashing, steel sector was continuously growing. So macro factors as such guys are going to affect all the companies. Examples will be inflation, will be interest rates that are prevailing, will be currency rates, will be unemployment levels as such guys, inflation rates. On the other hand, we have unsystematic risk that is on account of company specific factors. It can be because the company has a higher amount of fixed cost, it can be higher debt levels, it can be dependence on a single project, it can be useless management, anything as such guys. All of that will come under unsystematic risk. If you diversify your portfolio as such guys, you invest in multiple companies, then you will be able to diversify or reduce unsystematic risk. If you want to eliminate systematic risk, you stop investing in equity. Okay. That is the only way as such. As long as you keep investing in equity markets, there will be some amount of systematic risk. That cannot be eliminated. Or you can have exposure to multiple asset classes. So anyways, cost of equity में the first one guys without meditation is capital asset pricing model. The second and third method guys, sir said meditation. Did he look at me? Huh. The second and third method as such guys are dividend discount model. One is with at constant dividend, the other one beta is constant growth. Under constant dividend model as such guys, we write that the value of an equity share is the present value of all future dividends. Because the dividends are constant, you will use the formula of present value of constant perpetuity guys, and you're using present value of constant perpetuity, you will write price of an equity share as dividend divided by KE. That is KE is equal to D divided by P naught. If dividends grow at a constant rate, you will have to use present value of constant growth perpetuity. This is where you will write KE is equal to D1 divided by P naught plus growth rate. Are we clear guys? This is under dividend model. Apart from this, there were two other methods called as realized yield approach guys and earnings price approach. Under realized yield approach, whatever is the actual return that you have generated in the past as such guys, itself shall become the cost of capital, cost of equity. If you have generated 50% in the past, cost of equity is 50%. If you have generated negative 10% in the past, cost of equity will be negative 10%. Do we practically use this? No. Actual return cannot be the basis guys for cost of equity. Risk should be the basis for cost of equity. Under realized yield approach also beta, if you recall, there were two questions, both of them based on different assumptions. In one question, they did not specify prices at the end of each year. So I directly equated present value of dividends and the selling price to purchase price. We computed IRR at which the present value of all dividends that we have received and the selling price is equal to our purchase price. There was another question in which they gave price at the end of each year. If they give price at the end of each year, whatever dividends that you are receiving is assumed to be reinvested in the same company. So by doing this, the number of shares that you own will keep increasing year after year. Then you directly take whatever is the sale proceeds of all the shares and equate it with the principal amount, just like what you did under zero coupon bond. Accumulated balance is equal to P into 1 plus R whole power n. समझ में आए दोनों cases? When will you follow the first case? When price at the end of each year is not given. You directly take present value of all dividends and selling price and equate it to your purchase price. When will you follow the second price? Mandatory. When price at the end of each year is given. If it is given, it is mandatory as such guys for us to reinvest all the dividends. Is that clear? Last bench here. You will have to reinvest all the dividends in the same stock. Then comes earnings price approach. Earnings price approach as such guys is similar to dividend discount model, but instead of taking only dividends into consideration, we take earnings. You'll write P naught is equal, KE is equal to E divided by P naught. Now, you will not use earnings price approach as such guys as long as there is information available for the other methods. If they give us CAPM details, use CAPM. If not that, dividend details are given, use dividend discount model as such guys. If nothing is given, last resort is earnings price approach. We did that in only one question as such guys, wherein we wrote cost of equity as E divided by P or 1 divided by P ratio. 1 divided by P ratio. Are we clear about this? After this beta, we moved on to the concept of cost of retained earnings. I said the cost of retained earnings as such, guys, is exactly the same as cost of equity. Reason being, retained earnings are also funds that belong to equity shareholders. So there should not be any difference as such, guys, between cost of equity and cost of retained earnings. But there was one minor difference that we have learned, guys, and that is if in case a company as such better retains the amount, then for reinvestments as such, guys, they do not have to issue new equity shares. If they do not have to issue new equity shares, there is no flotation cost. So cost of retained earnings ke liye as such beta, you should not consider flotation cost if any given in the question. For cost of equity, because you will have to issue new equity shares, you will have to incur flotation cost. You will have to consider that flotation cost. So if they mention, just say last question that we did yesterday, 130 rupees is the current market price, but the new share will be issued at 125 and you will incur a flotation cost of 5 rupees. Cost of retained earnings will be based on 130. Cost of equity will be based on 120. That's the only difference between cost of retained earnings and cost of equity. What if they mention, guys, that because of the new capital structure, overall market price itself is reducing? If there is an actual reduction in the share price, now you will have to consider that reduced price for both cost of retained earnings as well as cost of equity. There will not be any difference if the market price itself is reducing. That's only in one question again. They mentioned in brackets in an RTB question that the price itself is reducing. Baki pure questions mein beta, you assume that it is only on account of new issue. That is why it is discount and flotation cost. Are we clear about this, guys? That's the difference between cost of equity and cost of retained earnings. Now, whenever you're computing specific cost of capitals, that is debt or preference or equity, guys. That is debt or equity as such, guys, or preference. Remember, all the valuation models wherein you take present value of all the future cash flows will not include D naught or interest for the current year. They all include cash flows from the next year. You include D1, D2, D3, D4. Just say if you're computing P naught as such beta, it will be present value of D1, D2, D3, D4, so on. So this P naught does not include D naught. So this is where I explain the concept of cum dividend and ex dividend. In case cum dividend price is given, that is if the price is inclusive of D naught, before you compute cost of equity, you should remove D naught. Convert that cum dividend price into ex dividend, and after that compute whatever is your cost of capital. There was only one question again on this asad beta, in which they give price of preference shares on a cum dividend basis. We first deducted the amount of dividend, converted that into ex dividend price, and then computed cost of preference share capital. Yaad aa raha hai? This is where by default it will always be on an ex dividend ex interest basis. If they specifically mention that it is cum dividend or cum interest, only then you will have to make this adjustment. After this beta, we moved on to the concept of weighted average cost of capital. Weighted average cost of capital is nothing but the overall cost of capital. So when you say that you will be using cost of capital for the purpose of evaluating business decisions as such, guys, it is this discounting rate as such beta that we are going to use for the purpose of evaluating business decisions. Are we clear about this? So to compute KW or KO, that is your overall cost of capital, guys, all that you have to do beta is simply take individual cost of capitals, multiply them by the corresponding weights. It is preferable to write weights in the table up to 4 decimal points, cost of capital up to 2 decimal points. That should be the way you are presenting the answer in the examination, rather than simply multiplying amounts and writing the final answer. Depends on your end goal again. So here, guys, weights, once you've computed cost of capitals, that part is done. Weights ka part abhi aata hai. It can either be based on book value weights or it can be based on market value weights. If weights are based on book values, end of discussion again. Whatever values are given as such beta, you directly consider them. If it is market values as such, guys, you will have to multiply number of securities with the current market price. If nothing is given as such, guys, you can very well assume that the market value of debentures or debt instruments as such, guys, and preference share capital is equal to their book values. Because these are fixed income securities, there will not be much fluctuation. The market values will be more or less the same as book values. It is only equity, guys, for which market value will substantially be different from book values. Are you clear about this? Now, what do we normally prefer practically, guys? We prefer market value weights because the intention is to arrive at the value of a company and considerations will be exchanged based on the prevailing market values. But apne exam ke liye kya karo bola main? Unless otherwise given as such, guys, you will have to follow book value weights. Lately, they have been specifying in the question as such, guys, that you're supposed to use market value weights or book value weights. Majority of the questions are asking on market value weights. So if they specify that, obviously better you know what is to be done. If nothing is specified, please do it on the basis of book value weights. Now, the market value of equity share, guys, is a market value of all equity shareholders funds. It is not the market value of only equity, or it is not the market value of only retained earnings. So when you say market value of equity, guys, and you have to compute overall cost of capital on the basis of market value weights, you will have to segregate this into equity share capital, guys, and retained earnings in the ratio of the book value of the capitals. It will be mandatory for you to segregate this if cost of equity is not equal to cost of retained earnings. But if cost of equity, guys, is equal to cost of retained earnings, you do not have to segregate. You can simply write equity share capital plus retained earnings and write the entire market value at once. When will you do that? If cost of equity is equal to cost of retained earnings. If they are not equal, you will have to divide the overall market value into equity share capital and retained earnings in the ratio of their book values. This is about overall cost of capital. इसके बाद में बेटा we did the concept of marginal cost of capital. Marginal cost of capital is also overall cost of capital, but only in respect of the additional funds that are being raised. So when you're computing marginal cost of capital as such, guys, there will not be any difference between book values and market values, because when you're raising additional funds, everything will be at the prevailing market prices. Are we clear about this, guys? Yes or no, beta? This is what we did, guys, in the entire chapter. Of course, here and there, beta, we have used. Okay, one more point. Under dividend discount model, guys, with growth rate can either be based on past earnings, if not given in the question, or it can be based on Gordon's model. Past earnings, they will give you data of the past as such, guys. You'll have to establish the relation between them and get the growth rate. Or under Gordon's model, you will write growth rate as retention ratio into return on equity, B into R. Explanation for that was already discussed in the class. And then there were 1-2 questions, guys, in which they asked us how much can you spend before new equity shares are to be issued. So for that, you should know what is the existing capital structure. You should know what is the proportion of equity. That proportion of equity as such, beta, is being funded through retained earnings. So if retained earnings are 80,000 and the proportion of equity is 80%, I can invest 1 lakh. 80,000 divided by 80%. Because if capital investment is 1 lakh, investment required through equity will only be 80,000 and I have retained earnings available. The minute investment crosses 1 lakh, amount of equity will be more than 80,000, but we have only 80,000 in the form of retained earnings. From where will you get the excess amount? Issue of equity shares. Is that clear, beta Karthik? That's it, beta. That is what we have covered as such, guys, in cost of capital. Any other point, guys, that we missed? Whenever market prices are given, I told you that you should compulsorily compute cost of capitals on the basis of those market prices. A question where sale price was given. Because sale price was given, I said net proceeds should not be based on market price. It should be based on sale price. Correct, guys? Chalo beta. Alright, guys, let's quickly revise leverages. So under financing decisions as such, beta, that is determining whether we should be raising our funds in the way of debt, equity, by way of debt, equity, or preference. We did the concept of leverages as well. So to understand leverages, I said you should know what is cost structure, you should know what is capital structure. Cost structure is a proportion of variable cost and fixed cost in the overall cost of the company, guys. I said automated companies will have a higher amount of fixed cost, lesser amount of variable cost. Entities where manual work is more will have a lesser amount of fixed cost as such, guys, but have a higher amount of variable cost. And then beta, capital structure is the proportion of debt, equity, and preference. Debt and preference are considered to be fixed obligations. That means you will have to provide a return to debt providers as well as your preference shareholders. Equity is supposed to be a variable obligation, but only if you are generating sufficient amount of profits, guys, you may, if you wish, to declare dividend. Otherwise, even that is not compulsory. Whenever there's a change in sales, guys, between your variable and fixed cost, it is only the amount of variable cost that changes proportionately. Fixed cost remains constant because only a part of your total cost is changing proportionately as such, guys. Your profits are going to increase by a higher proportion. Meaning if sales change by 1%, total cost will change by less than 1%. That is why the profits will increase by more than 1%. To what extent will the profits increase by, guys, will depend on the proportion of fixed cost. higher the proportion of fixed cost, lesser will be the increase in total cost whenever sales increase. Because there'll be a lesser increase in total cost on account of increase in sales, guys, profits will increase by a higher proportion. Are we getting this, guys? Likewise, whenever your operating profit EBIT is changing, guys, the amount of money that you will have to pay to debt providers and to preference shareholders will remain constant. Because it will remain constant as such, guys, the amount of money that is available to equity shareholders, guys, will change. If operating profit is changing by 10%, guys, that does not mean return available to equity shareholders will change only by 10%. It can change by a higher proportion. So to know what is the relation between change in sales, change in operating profit, and to know what is the relation between change in operating profit and change in earnings attributable to equity shareholders, we have computed leverages. So for this, guys, as said, you should know that there is fixed operating cost and there is fixed financial cost. There is business risk and then there is financial risk. Business risk is on account of operations of the company, guys. That is a measure of, that will depend on your fixed operating cost. Financial risk as such, guys, is on account of capital structure. So that as such beta will be on account of fixed financial cost. One is on account of fixed operating cost, the other one is on account of fixed financial cost. So for this risk as such beta, we have operating leverage and financial leverage. Operating leverage measures the relationship between sales and operating profit on account of fixed operating cost. Financial leverage measures the relationship between earnings available to equity shareholders, guys, and operating profit on account of fixed financial cost. Are we clear, guys? So to arrive at operating leverage, beta, I said the formula for operating leverage, guys, would be, we've done many examples, guys, to understand this. Operating leverage, guys, will be percentage change in EBIT. How is your operating profit changing for every 1% change in sales? So if a 10% change in sales has resulted in a 30% change in EBIT, it means our operating leverage is 3 times. For every 1% change in sales, my operating profit will change by 3%. Correct, beta Jivesh? Said Matt. The other formula, guys, for operating leverage is such beta will be profit before fixed financial cost, profit before fixed operating cost divided by profit after fixed operating cost. And that beta will be contribution divided by EBIT. That's the other formula, guys, for operating leverage. We normally use this formula only, guys, and not percentage changes. They might give percentage changes as such, guys, to arrive at your operating leverage. In few questions they might give. Otherwise, majority of the questions, guys, you've always computed contribution divided by EBIT. Likewise, guys, in order to arrive at financial leverage, guys, you will write percentage change in, if there is no preference share capital, it will be percentage change in EBT or EAT or earnings attributable to equity shareholders. Does not make any difference. If there is no preference dividend, I can take percentage change in EBT, EAT or earnings attributable to equity shareholders. That divided by percentage change in EBIT, operating profit. The other formula beta is profit before fixed financial cost divided by profit after fixed financial cost, which is EBIT divided by EBT. EBIT divided by EBT. That is how you're going to compute financial leverage. Are we clear about this, guys? After that, beta, now talking about all the aspects under operating leverage. First, operating leverage as such, guys, is related to your normal break-even point and margin of safety. If a firm has a higher amount of fixed cost as such, guys, it will need a higher amount of sales to break even, to recover that fixed cost. That is why a higher fixed cost will result in a higher operating leverage, but at the same time will also result in a higher break-even point. Also, guys, operating leverage and margin of safety are inversely related. Operating leverage and break-even point directly related. Higher fixed cost, higher leverage, higher break-even point. But that and margin of safety, guys. What is margin of safety? Excess sales over and above your break-even point. You've derived it in the class that you can write operating leverage as 1 divided by margin of safety, but in percentage of overall sales. So if overall sales may say break-even sales are 80%, margin of safety is 20%, then my operating leverage beta will be 1 divided by 20%. That is 5 times. Are we clear about this, guys? Now, operating leverage value, guys, usually will be more than 1. Any company as such, beta, profit-making company, if it has some amount of fixed cost as such, guys, your operating leverage is supposed to be greater than 1. Higher the amount of fixed cost, higher will be the leverage value. Operating leverage can be negative, guys, if it's a loss-making entity. That means your contribution as such, guys, is not sufficient to absorb the entire amount of fixed cost. If it is not sufficient to absorb the entire amount of fixed cost, your operating leverage undoubtedly is going to be negative. And at exactly break-even point, guys, wherein your contribution is equal to fixed cost, where EBIT is 0, operating leverage as such, guys, is going to be undefined. Because when you write contribution divided by EBIT, that is contribution by 0, you will get an undefined value. Leverages cannot lie between 0 and 1. They can be negative, they can be 0, they can be negative, they can be undefined, or they will be more than 1. Are we clear about this, guys? Yes or no, beta? Then, guys, financial leverage mein beta. One more important part, operating leverage, your financial leverage, it is always computed at a particular sales level. As you keep increasing the amount of sales as such, guys, leverage value will change. It is not going to remain constant. With an increase in sales, leverages decrease. Because the proportion of fixed cost beta will keep reducing. Your variable cost will keep increasing. So leverages decrease whenever there's an increase in sales. Risk reduces, guys, as you keep increasing your sales. Now under financial leverage, guys, I spoke about something called as, so financial leverage ka value bhi same rahega beta. It will be more than 1, or it will be 1, or it will be undefined or negative. I spoke about trading on equity, guys, and I spoke about double-edged sword. I said entities would want to borrow money and incorporate that in the capital structure as such, guys, because the amount of equity portion will be limited, guys, and if they are able to generate a higher return as such, guys, then if they are able to generate a higher return than the cost of debt as such, guys, they will be able to maximize the return that is available to equity shareholders. It is for that purpose as such, guys, that entities would want to incorporate debt. So trading on equity is exactly this, guys. With the given amount of equity, we are creating a larger capital base by incorporating debt, and we will still try to increase the return that is available to shareholders by ensuring that we generate a higher return than cost of debt. Isko bolte favorable financial leverage. So if they ask us to check whether the financial leverage is favorable or not as such beta, you will simply go by ROI. You will compare ROI and KT. If ROI, guys, is less than KT, then obviously as such beta it is unfavorable, and the entity as such, guys, is going to, incur losses, or the return that is available to equity shareholders are heavily going to get impacted. Double-edged sword, guys, leverage is exactly the same concept. So here what did we learn, guys? I said beta that leverage, undoubtedly having higher amount of leverage is advantageous, because when sales increase, profits will increase by a higher proportion. At the same time, guys, when sales reduce, profits will decrease by a higher proportion. So in case beta a company's profitability has reduced and ROI is less than KD, then beta leverage will backfire the company. Yes or no? That is leverage being a double-edged sword. And then, guys, I said analysis of combined leverage also. Yahan tak samajh mein aaya sabko? Under analysis of combined leverage, I said if both operating leverage and financial leverage is low, guys, then the overall risk is very less. This is not considered to be an optimum thing. If both of them are very high as such, guys, then it will be way too risky. If operating leverage is very high, guys, that means your fixed cost is very high. As it is, EBIT will be very less. If EBIT is very less, you will never be able to multiply capital by incorporating debt, which means you will not be able to take advantage of debt. That is why, guys, even this is not considered to be a better combination. The best combination is where the operating leverage is less but financial leverage is high. A lower operating leverage would ensure that you have a higher EBIT. A higher EBIT will ensure that you have a higher debt repayment capability. So you will be able to incorporate a higher amount of debt and take advantage on account of debt. Are we clear? So the best combination is where operating leverage is less and financial leverage is high. There can be entities beta that will not believe in financial leverage. I told you many companies these days are shifting to zero debt. They do not want any amount of debt only. In such cases, beta financial leverage will be 1:1. There is no financial leverage at all. Is that clear, guys? Iske alawa, guys, here and there we have used certain formulas. Asset turnover ratio 1. It is the efficiency of utilization of assets. So for asset turnover ratio, guys, you will write sales divided by assets. It is basically what is the amount of revenue that you are generating as such, guys, for every 1 rupee of asset. Alright, guys. Then we did return on investment, guys. Return on investment or return on capital employed is a return available from the viewpoint of all the providers of capital. That is when the denominator you will take capital employed or you will take total assets. In the numerator as such, guys, you will take EBIT. If it is post-tax, you will write EBIT into 1 minus tax rate. Are we clear, guys? Earnings yield, guys. Earnings yield is what? Earnings as a percentage of market price. P ratio beta is market price per share divided by earnings per share. That's it, right? Then beta, we did leverages with preference share capital. Now, operating leverage is not going to change, guys, whether or not your preference share capital, because preference dividend is a fixed financial cost. It is not a fixed operating cost. So whether we have preference share capital or not, it doesn't make a difference. You're still going to write operating leverage as contribution divided by EBIT. If there is preference share capital, then while computing, guys, financial leverage, I should not only consider interest, but I should also consider preference dividend. That is why, guys, I said the formula is EBIT divided by EBIT minus interest minus preference dividend by 1 minus tax rate. We are making adjustments to pre-tax profit. That is why we are converting preference dividend also better to pre-tax figure. We are grossing up preference dividend and arriving at the amount of pre-tax profit that is required to pay preference dividend. In terms of percentage changes, no longer can we write percentage change in EAT, EBITDA or EBT. The only thing that you can write is percentage change in earnings attributable to equity shareholders, guys, divided by percentage change in EBIT. If there is preference share capital, even combined leverage obviously is going to undergo a change, guys. Earlier combined leverage ka formula was contribution divided by EBT. Now it is contribution divided by EBT minus preference dividend by 1 minus tax rate. Alright, guys. Earlier you could have taken percentage change in EBT, EAT, EPS, earnings attributable to equity shareholders. Now you will take only percentage change in EPS or earnings attributable to equity shareholders. Now you will see that common beta in many questions, that a 25% reduction in sales has wiped out the EPS. Uska matlab kya hoga? A 25% change in sales as such, guys, has resulted in a 100% reduction in EPS. So you will know better how to arrive at combined leverage and use that as such, guys, to compute the other missing figures. Is that clear, kids? Very good, better. Let's quickly revise, guys, capital structure theories. So this entire chapter better deals with how should you be procuring your source, how should you be procuring your capital, whether you should be raising funds in the form of equity, in the form of debt, or in the form of preference. We have learned multiple factors that affect our choice of capital, guys. We have just revised those factors now also. The 3 primary factors that affect the choice of capital, guys, is the cost of capital to the company, risk to the company, dilution of control. Iske alawa, we have always been talking about tax advantage. When I talk from the perspective of risk to the company, when you're raising funds in the form of debt, you are under an obligation to pay interest, you're under an obligation to pay principal, no matter what is the outcome. That is why the risk increases when you're raising funds in the form of debt. The risk would be substantially lower, better, or there's no risk when you're raising money in the form of equity. So from a risk perspective, we would raise money in the form of equity. Then better, talking about cost of capital. From the perspective of an investor, guys, the investor takes lesser amount of risk when they invest their funds in debt. Because if something goes wrong with the company, guys, it is debt providers that should be paid first and then equity shareholders. So if you talk about cost of capital, the investors, because they take a lesser risk as such, guys, when they're investing in debt, their expectation, guys, would be lower. Hence, the cost of capital, guys, for debt would be lower. So in order to reduce your overall cost of capital, a company would prefer raising funds in the form of debt. Dilution of control, if you're raising more money by way of equity as such, guys, the control of the existing owners will get diluted. So to avoid that dilution, again, you will prefer raising money in the form of debt, guys, not in the form of equity. Iske alawa, guys, the principles that we have learned today. I said in case the company is something which is financially stable, there is a stable sales growth that is expected and the profitability is good, then the company will not mind raising money in the form of debt, because there will be sufficient profits available to repay your interest and to repay your principal. But if the company is in the early stage of business as such, guys, then they would not prefer raising money in the form of debt, they would prefer raising money in the form of equity. Alright, flexibility. Sometimes when you borrow money in the form of debt, guys, the debt providers can put restrictions that you will not be able to borrow additional amount till you repay the existing one as such, guys, or the existing interest might increase if you are borrowing an additional debt. So that flexibility as such, guys, will be a major concern when you are raising funds. You will want, guys, all the options available as such, better, for you to raise funds on a later date. Is that clear, guys? Now, After this, beta, I said this chapter is primarily divided as such, guys, into two major parts. There are capital structure theories, and then beta there is optimum capital structure. Capital structure theories better talk about what factors are we supposed to take into consideration, or how will your cost of equity and overall cost of capital change, guys, whenever we are changing our debt equity levels. A majority of these theories better that we are doing assume that there are only two sources of funds, that is debt and equity. There will not be any taxes applicable. Business risk is assumed to be constant. If at all something changes, that would be financial risk. Now, under this, guys, irrespective of the theories, if taxes are not applicable, remember, from EBIT, if you deduct interest, you directly arrive at net income. Why do you arrive at net income, guys? There is no preference dividend, there is no tax. That is why, guys, EBT, EAT, net income are all the same. To arrive at value of the entire firm, you will write EBIT by KO. To arrive at value of the equity, you will write net income divided by cost of equity. This is what we will use in every theory as long as taxes are not applicable. As per net income theory, guys, which is the first one, irrespective of the debt level, the risk to equity shareholder remains constant, and because of that, beta, your cost of equity will remain constant. So as you keep increasing the amount of debt as such, guys, your overall cost of capital, beta, will keep reducing. Because debt is a cheaper source of fund, cost of debt will be constant, cost of equity will be constant. As we are increasing the amount of debt, beta, kya ho raha hai? KO, beta, will keep reducing. This graph here, beta, tells us that your KO reduces as you keep increasing the amount of debt. This is net income approach. NOI approach, on the other hand, beta, tells us that no matter what is the level of debt, guys, your overall cost of capital is going to remain constant. Now, that is happening better because as you keep increasing the level of debt, the risk to equity shareholder increases, resulting in an increase in cost of equity. However, the increase in cost of equity will be offset by the lower cost of debt, which results in your KO remaining constant. How will they ask questions on NI and NOI approach? If a question is on NI approach, they will give us KE. Using KE, we will first arrive at value of equity. To that, you will add value of debt and arrive at value of the entire firm. Once you compute value of the entire firm, guys, using EBIT and value of the entire firm, you're going to arrive at KO. That is net income approach. If the question is based on NOI approach as such, guys, they will give us KO. Using KO, we will first arrive at value of the entire firm. From that, I will deduct the amount of debt and I will get value of equity. Once I get value of equity as such, guys, I can use value of equity and net income to compute cost of equity. Any doubt in this? Do not forget, if at all they mention NOI approach, guys, or if they tell you that everything is identical, you will have to keep KO constant. There are few questions in which KO of another company was not given, but then we have clearly specified that because it is NOI approach as such, beta, your overall KO is supposed to remain constant. And if they use the word NI approach, KE is supposed to remain constant. If they give different KEs, different KOs, you cannot question the question. You will have to use those values and arrive at the value of the firm. Then, beta, we did traditional approach. Under traditional approach, beta, is said that initially, guys, when a firm incorporates debt, there will be a reduction in the overall cost of capital because a slight amount of debt is not going to increase the risk of the shareholders better by a higher amount, higher proportion. Even if there's a marginal increase in the risk as such, guys, even if there's a marginal increase in cost of equity, your overall cost of capital will still reduce. But beyond an acceptable level as such, guys, there will be an increase in your KO because of a higher increase in cost of equity and also an increase in cost of debt. So as per your traditional approach, guys, there is only going to be one optimum capital structure. And that one optimum capital structure will be the point at which your overall cost of capital will be the least. As per NI approach, if you want to arrive at optimum capital structure, you have to keep increasing the amount of debt. And as per NOI approach, any capital structure will be optimum capital structure. How will they give questions on traditional approach? They will give us different cost of equities. They will give us different cost of debts. You just have to compute KOs. Select the financial plan as such beta that results in the highest value of the firm or the lowest overall cost of capital. Then we did Modi-Gilani Miller approach, guys. I said approach, guys, without taxes and with the taxes. Approach without taxes is exactly a copy of NOI approach. Are we clear, guys? There will be no change in formulas also as such, guys. You will still write EBIT divided by KO as a value of the firm. Net income divided by cost of equity, guys, as a value of equity. After that, beta, if it is approach with the taxes, then I said a levered company, that is one which has debt, will always have an advantage over an unlevered company. An unlevered company does not have any debt, levered company has debt. What is the advantage that a levered company has over an unlevered company? Because of taxes, guys, they will save a certain amount. Because of interest as such, guys, they will save on taxes, and hence the total earnings that are available for distribution to both equity shareholders and debt providers will be higher, exactly higher by the amount of tax savings on interest. This is where, beta, if taxes are applicable, you will have to first identify which of these companies is an unlevered company and arrive at the value of unlevered company. The value of an unlevered company as per approach, beta, is EBIT into 1 minus tax rate divided by KO. Once you arrive at value of an unlevered company, the value of a levered company, beta, will be VUL, value of unlevered company, plus tax advantage on account of debt. I have derived how to compute tax advantage on account of debt in the class. For the time being, it is directly debt amount into this takes care of the present value of all the tax savings that you're going to get on interest. Are we clear? Do not forget, both the values are still value of the entire firms. They are not value of equity. We are still computing value of the entire firm only. If it's an unlevered firm as such, guys, value of the entire firm itself, beta, value of the entire firm, guys, itself will be value of equity. But if it's a levered firm as such, guys, from the value of the entire firm, what will you do? You will deduct the amount of debt, guys, and arrive at the value of equity. Is that clear, kids? Once you arrive at value of equity, guys, you will use net income and value of equity to compute cost of equity. Once you arrive at cost of equity, I said only for this KO ke liye you will have to use weighted average formula. Weight of equity into cost of equity, weight of debt into cost of debt. Everywhere else wherein we compute KO, we directly use value of the firm formula. V is equal to EBIT by KO. But if they ask KO of a levered firm, you should write weight of equity into cost of equity plus weight of debt into cost of debt. Weights will be based on market values. This chapter is all about market values. Previous chapter, beta, cost of capital, unless otherwise given, KO will be based on book values. Capital structure theories is about valuation. Valuation works on prevailing market values. That is why you should always take market values for computing your overall cost of capital. Any doubt in that part, guys? Yes or no, kids? Next, beta. Now, under approach, yaad rakhna, questions kaise aayenge? They will either give us two different types of companies, guys, or they will tell us that this is an existing company. You are raising 10 lakhs of debt and you are buying back equity shares. Usko kya ghur rahi hai beta tu? You are raising 10 lakhs of debt as such, beta, and you're buying back your equity shares. So you're basically converting an existing unlevered company to a levered company. Doesn't matter whether it is two different companies or an existing company, beta, getting converted from unlevered to levered. Valuation will still remain same. Are we clear? Yes or no, guys? Now, beta, if they ask equilibrium value, guys, what does that mean? A question mein yaad hai, they've used the word equilibrium value. Equilibrium value is value as per the approach, as per a specific theory. If I use dividend discount model and compute price of an equity share, that is equilibrium value. That may or may not match with the existing market price. So if they ask equilibrium value, you're simply supposed to compute as per the valuation model. Are we clear? Yes or no, guys? After this, beta, there were two other theories that we did, guys. That was pecking order theory and trade-off theory. Under pecking order theory, beta, I told you that the preference as such, guys, for capital structure would depend on the management's preferences. Normally, guys, what is the preference? First preference is always given to internal funds, which is in the form of retained earnings. Second preference will be given to external funds. External funds, beta, you will first give preference to external debt. If external debt cannot be raised, then you will give preference to equity shares. This theory also talks about management possessing more amount of information, guys. If management is giving preference to equity shares, it also means that the management is doubtful about the future profits. That is why they do not want to raise more funds in the form of debt and they are preferring raising money in the form of equity. If management is preferring raising money in the form of debt, that means they're confident about future earnings. That is why they do not mind borrowing more and more debt. Are we clear? Next, beta, we spoke about trade-off theory. Trade-off theory talks about, guys, you striking a balance between the incremental benefit that you get on account of debt and the cost that you incur on account of debt. For this purpose, beta, benefit is only tax advantage that you get on account of debt. Benefit, guys, is only the tax advantage that you get on account of debt, whereas cost as such, guys, is segregated into insolvency, bankruptcy cost as such, guys, and agency cost. Financial distress cost, bankruptcy cost, insolvency cost, one and the same, and you will have agency cost. Under bankruptcy cost also, but I said there are direct and indirect cost. Direct cost is firm actually going into liquidation. If a firm goes into liquidation, what is the problem? The value that the firm would realize, guys, would be substantially lower than the value that they would have realized as a going concern entity. So that is where as such, but that reduction in value itself is your cost. What is the indirect cost of bankruptcy? All your other resources would now come at a higher price. Employees might start demanding a higher salary, better rentals might be high, suppliers might be demanding more favorable terms. What is agency cost, guys? I said there are three groups now. There are debt providers, there are shareholders, and then there is management. Not every decision taken by the management as such, guys, might be in favor of all the three groups. If at all there are disputes arising as such, guys, you will have to again incur cost as such, guys, in resolving those disputes. So as long as the incremental cost as such, guys, is greater than, as long as the incremental benefit is greater than the incremental cost, you should keep increasing debt. The minute incremental cost exceeds the incremental benefit, you should stop. You should not increase the level of debt. If you look at the graph, beta, you will realize based on that slanting upward curve, that should have been the actual value of a levered company if there were no cost associated. But because of financial distress cost, guys, it is not going upward on a straight line. The value starts declining. वो जो difference है बेटा between that shaded region, that is nothing but your financial distress cost. So this will help us in identifying as to what is the optimum capital structure. Yes or no, kids? These were all about the capital structure theories. Now under capital structure theories, guys, we also did arbitrage opportunity, जो आज किए थे बेटा. So arbitrage theory beta arises only under MM approach. I said under MM approach beta without taxes now. There are no taxes applicable here. Whether it is a levered firm or whether it is an unlevered firm, guys, the value is supposed to be constant. If the values are not same, you can always switch over from one firm to another firm, guys, and make paisa, make money. Yes or no? This will depend on which firm is undervalued and which firm is overvalued. The first thing that you will do, beta, is arrive at values of both the firms. For this, they will only give us cost of equity. If they do not give cost of equity and they tell us assume KO is constant, will there be any arbitrage opportunity? This is why in questions of arbitrage, KE will be compulsorily given. And your KO of both the firms is not going to be same. So you will first compute value of both the firms, then check which firm is undervalued or which firm is overvalued. If at all, guys, a levered firm is overvalued and an unlevered firm is undervalued, you will sell levered firm and buy. For this, either the percentage holding will be given in the question. If it is not given, you assume anything, preferably 10%. So when you are selling your shares in levered company, guys, remember you will also need to borrow money. If you are drifting away from the levered company, you should get money from both equity and debt. So you will sell shares, you will borrow money, use that entire amount and invest in unlevered company. How much will you borrow will depend on your percentage holding. If you own 15% shares, you will also borrow an amount equal to 15% of total debt. Use that entire amount and buy shares of unlevered company. But before you compute your increase in earnings, see what is your percentage holding, because that will determine how much share of net income are you going to receive. Are we clear, kids? What if levered company is undervalued and unlevered company is overvalued? You will sell your shares from unlevered company and invest that entire amount in levered company. When you're investing in levered company, I said multiple possibilities. But what is the possibility that we will stick to? Invest in both equity and debt in the ratio of their capital employed, existing capital employed, remember that. Now, once you do that as such, beta, again you will have to see what percentage of shares are you owning in the levered company and accordingly compute your increase in net income. इसके अलावा बेटा we did optimum capital structure. Optimum capital structure के नीचे बेटा there were three things that we did. One was EBIT, EPS, MPS analysis. The other one beta was financial break-even point and then indifference point. EBIT, EPS, MPS analysis, guys, is basically computing earnings per share, market price per share, guys, at a specific EBIT level. ना भाई. You are going to compute. ज़्यादा ही solve कर लिए नहीं questions. EBIT, EPS, MPS analysis, guys, you are going to arrive at the amount of EPS and MPS at a specific EBIT level. You will have to select the alternative that results in a higher EPS. If at all information is given to compute market price of the share, guys, you will select an alternative that results in a higher. Now for these questions, guys, if you recall, they will give you some existing capital structure. They will tell you that you need more funds and you will have to raise that either by way of debt or raise that money either by way of equity. Ya to they will tell us what is the absolute increase in EBIT. Yeah, they will give us return on investment. They will tell us that the existing return on investment will remain constant, or they might give us a percentage increase in ROI. Doesn't matter how are they giving us the information. Our job will be to compute new EBIT, deduct new interest, existing interest, arrive at EPS. If P ratios are given, multiply by P ratio and arrive at MPS. P ratio mein they can change the factor. How will they change? Depending on debt ratio. If the word debt ratio is used, it is debt divided by total capital employed. You will have to compute that percentage, see whether it is within the acceptable level or is it breaching that limit. If it is breaching the limit, obviously your P ratio is going to reduce. जो भी है बेटा, it is going to change. समझ में आ गया ना guys? In one question, instead of giving you existing EBIT, he gave you interest coverage ratio. I said interest coverage ratio is nothing but EBIT divided by the amount of interest. But पूरे questions ऐसे ही रहेंगे बेटा. They will give us ROI, they will give us interest coverage ratio or existing EBIT, compute new EPS, compute new MPS. मरो बोल के. Are we clear about that? So that is EBIT, EPS, MPS analysis. Then what is financial break-even point, guys? Financial break-even point, beta, is the point wherein we continuously yawn in the class. Or it is the level of EBIT at which EPS is 0. They'll stare at me. Did he talk about me? Then they realize Nage Chusrananta is talking about me only. You start with EPS 0. That means earnings attributable to equity shareholders will be 0. You add back preference dividend, you add back taxes, you add back interest, and then you will arrive at EBIT. That will become your financial break-even point. Next, guys, is indifference point. Indifference point, beta, is computing the level of EBIT at which EPS under two different capital structures will remain same. What is the advantage of computing indifference point? You will, once you compute the indifference point, guys, based on the expectation, if the expected EBIT is less than the indifference point, guys, you will select the alternative with lower fixed financial cost. If the expected EBIT is more than the indifference point, you will select the alternative with a higher fixed financial cost. Are we clear about this, guys? Now, for computing this, you will have to equate EPS under alternative 1 to EPS under alternative 2. I hope you remember that. EBIT minus interest into 1 minus tax rate minus preference dividend divided by number of equity shares will be equated to the same thing under the other capital structure. Now, if the number of equity shares are not the same under both the financial structures, you will have only one indifference point. But if the number of equity shares are exactly the same under both the financial structures, then there are two other possibilities. Either every EBIT level is an indifference point or there is no indifference point at all. When will every EBIT be an indifference point? सब कुछ strike हो जा रहा है बेटा. Equation is still holding good. That means irrespective of what EBIT level that you take, the EPS is going to remain constant. I give you an example, beta. Say 5 lakhs equity, 5 lakhs equity. Under one we have cost of debt as say 12%, post-tax 6%. Under the other we have 6% preference share capital. Now obviously because the post-tax cost of capital of both debt and preference share capital are same, every EBIT will result in the same indifference point. When will you not have any indifference point? Equation does not hold good, beta. LHS is not equal to RHS. In that case, as such, guys, you know that one capital structure will always be superior. It will dominate the other capital structure. There was another question in which they gave us 5 different EBITs as such, guys, and they've asked us to compute EPS under all the alternatives. There, without computing indifference point, we were able to arrive at the same conclusions. वहां पे क्या याद रखना था? I told you that even if profits are not sufficient, you will have to pay interest, you will have to pay preference dividend. If you have losses, consider tax savings. याद है नहीं है guys? Next better. After EBIT, EPS indifference point, guys, we did nothing. We did undercapitalization and overcapitalization. Undercapitalization is the point as such better where the capital employed is less than what the firm can profitably deploy. Matlab there is a scope of increasing the total amount of investment as such, guys. Yes or no, beta? There's a scope for increasing the total. All right, there is a scope for increasing the total amount of investment and increasing the profitability, guys, of the equity shareholders. That is undercapitalization. You can invest more, you can generate a higher return. When your existing ROI is way too high as such, guys, it is usually a case of undercapitalization. Overcapitalization, beta, is having more capital than what you can profitably deploy, or your existing investments are useless. They are resulting in a very less return. Are we clear? If it's a case of overcapitalization, guys, you can either distribute excess funds back to the shareholders through buyback or internal reconstruction. Reduce the value of share, enter into agreements with providers of debt as such, guys, to reduce the total claims of them, sell unprofitable, jo bhi it is not suitable anymore as such, guys. If it's a case of undercapitalization, better raise more money by way of debt or by way of equity and deploy that in the business. Among the two as such, guys, which is better? Under capitalization. समझ में आ रहा है नहीं आ रहा है guys? That's it better.